Welcome to Shares from the American College of Financial Services, where money meets minds. Here's a look at what we'll be sharing with you today.
People get really hung up on all the different crediting strategies and all the different indexes, and I'm sure we're going to talk about that. But at its essence, this is a fixed deferred annuity product where instead of getting a fixed rate, you get an indexed rate. And the way that they fuel that indexed rate is options.
I'm Michael Finke, Director of the college's Wealth Management Certified Professional Program, and your host for this conversation on specialized knowledge. I'm joined today by Bobby Samuelson, President of Life Innovators and Executive Editor of the Life Product Review. He's an expert on annuity products and their uses, and we're excited to have him on the show. Bobby, welcome to the podcast, and thank you for sharing your knowledge with us.
Thanks for having me. Excited to do it.
Bobby, I'm really excited to talk to you because something that you bring to the table that a lot of people don't fully understand, and I think our audience is very interested in knowing more about, in particular, fixed index annuities and RILAs. Both are very popular types of annuity products right now, and they're both highly complex.
Yep.
And the way they're assembled is complex, and the characteristics that advisors need to pay attention to is, I think, not well understood. So what I'm hoping to do in this discussion is to demystify the elements and maybe even talk a little bit about how advisors can make bad decisions when it comes to selecting some of these products and what to pay the most attention to. So, Bobby, can you please take us through the process from the perspective of the insurance company of creating a fixed index annuity, and tell us a little bit about just the fundamental characteristics of the product?
Yeah, sure. So I agree that they can be complex, but I think this is an example of one of these things. The more you understand it, the simpler it actually is. And so I think if you look at all the glossy marketing brochures and you look at all the different crediting strategies out there, it is so easy to become overwhelmed. And I think kind of paralysis sets in on like, how do I pick a product? How do I pick a crediting strategy? How do I pick, to your point, between an FIA and a RILA, or even we're seeing defined outcome funds and VAs, or even a MIGA? How do I pick between all these things? They're all kind of similar constructs, but they have these different strategies in them. So what are the different virtues of these different options? And so to me, the simplest way to think about it is just to boil it down to its essence, right? Where does this thing actually start, and then build up from there? And so where it starts is actually the commonality really amongst, at least MIGAs and FIAs, which is these are all fixed deferred annuity products. And if you stretch back to what a fixed deferred annuity is, it's a very simple idea. You put premium in and the carrier goes, they buy investments, usually corporate fixed income. Increasingly, though, carriers are becoming more exotic in how they invest the money, which is a conversation maybe we'll get to later. But they go out there, they invest. If you buy a 5-year fixed deferred annuity product, they're theoretically buying 5-year assets, and they're taking the yield from those assets, they're taking a spread, and they're crediting the rest back to the annuitant, and so the owner of the annuity. And so the idea is, this annuity basically credits interest that looks sort of like fixed income. But it doesn't have the same risk level as fixed income because you have insurance guarantees on it. And so you get things where you might credit 4 or 5% per year. And on a traditional fixed deferred annuity chassis, that 4 or 5% per year can change. Carrier can declare different rates over different periods of time. And so you'll have different rates. The longer you hold the policy, you'll get different rates that reflect sort of the underlying asset, underlying assets that the carrier is using to invest for the contract. So that's the way every fixed deferred annuity works. It's the simplest structure. There's no explicit fees. So, unlike a life insurance policy, we have cost of insurance charges and you have fees related to commissions, base charges and premium loads. You don't have that on an annuity. If you put $100,000 into a fixed deferred annuity, you've got $100,000 of value that's working for you. Now, it's not liquid. You're going to have surrender charges on it. But the value's there. It's earning interest. And again, over 5 years, 7 years, 10 years, however long the surrender charge schedule is, you're going to get back premium plus interest. And the interest, again, is related back to the underlying assets. So don't overcomplicate it. Every annuity basically works that way. If you kind of step up and say, okay, well, what are the different variants then? A MIGA, as we all know, is effectively a fixed deferred annuity with a guarantee option period. So the carrier says, all right, instead of varying the rate every year, we'll lock the rate in for a certain term. And usually the term matches the surrender charges. So if we have a 5-year surrender charge, you have a 5-year guaranteed term. Simple as that. Now, on an FIA, it is effectively the exact same thing as a fixed deferred annuity, traditional fixed deferred, but there's one key difference. And the difference is that instead of the carrier giving you a crediting rate, so instead of saying, all right, we're going to give you 4% interest that's going to compound daily, they take that 4% and they go out and they buy call options. And so this is where, the fixed deferred turns into something quite a bit different, because now we're talking about an options strategy that's fundamentally underlying the performance of the contract. And the way that the carrier translates that option strategy into policy performance is through these indexed crediting mechanisms. And so let's say, look, in simplest form, like if you want to buy exposure to the S&P 500, we'll maybe say, okay, you can have the S&P 500. We're going to give you a 50% participation rate just to keep it easy. So if the S&P is up 10%, you get 5%. S&P is up 5%, you get 2.5%. And, we're going to set a 1-year time horizon on that. So at the end of 1 year, we're going to see what the index is up. We're going to apply your par rate, and that's what you get. And that's not magic. The carrier isn't out there investing in equities. They're not doing any of that themselves. What they're doing is buying call options from an investment bank using your money, not their money, your money. You could have earned the 4%, and instead you took, in this example, the 50% par rate. And so, again, I think people get really hung up on all the different crediting strategies and all the different indexes, and I'm sure we're going to talk about that. But at its essence, this is a fixed deferred annuity product where instead of getting a fixed rate, you get an indexed rate, and the way that they fuel that indexed rate is options. And that really is all there is to it.
So Bobby, let's make a few points here for the audience. First of all, why the annuity chassis? What is it that's valuable about the annuity chassis? And let's start with something like a MYGA, because a MYGA is essentially a substitute for a bond portfolio or a portion of a portfolio that you would have invested in bonds. What type of bonds is that comparable to, and what are some of the benefits of holding it within the annuity chassis?
Yeah, so two big benefits. One is you get insurance guarantees. And so you have a guaranteed minimum amount that you can take out, and that's standard non-forfeiture law. And so every dollar you put into an annuity, there's a certain minimum value that has to come out over a certain period of time. And so, it starts off less than the premium you put in, but it grows at a guaranteed interest rate. And so you have a stability that you don't have in a bond. So for example, if you had bought corporate bonds in 2021, suddenly 2022 rolls around, the value of those bonds dropped dramatically. And yes, the value of the carrier's bonds that they bought to back your annuity dropped, but the value of your annuity did not drop. So you have market value adjustments in annuities, but they're pretty thin relative to what actually happens in the overall market. You're not going to get the same markdown in a MYGA with an MVA with a market value adjustment than you do if you actually own the bonds. So those insurance guarantees are a big piece of it. You also are taking a different type of credit risk. So if you think about the other level of the guarantees, who is making the guarantee? Well, instead of actually buying the bond and being on the corporate or the risk for the actual corporate credit you're taking the risk at the insurance company level. And so basically the insurance company can do, a diversified bond portfolio or a diversified credit portfolio. And you don't have to have all the credit risk of each individual counterparty or each individual borrower. You take the risk at the insurance company level. And so that's all part of the insurance guarantee structure that makes this, by the way, an insurance product. It's not a registered product. It's a insurance product, and those insurance guarantees are valuable. The other piece, of course, is tax deferral. And really what I would say is tax control. And so you can hold this policy. You don't pay taxes until you go and access the money. If you get to the end of the surrender charge period and you want to exchange it into a new contract, you can do a 1035 exchange and keep that tax deferral going for a period of time, really however long you want to. Now, the moment you access the money, what you pay for effectively is you have to get taxed on ordinary income on your gains. And so you might have had long-term capital gains. You might have had qualified dividends. You might have had other stuff had you actually owned the actual underlying portfolio. Here we convert all of that into ordinary income, but it's ordinary income that is coming, and you control it effectively because you get tax deferral on the annuity chassis. So why annuities? Insurance guarantees, tax deferral. And I'd say those are the two kind of big things. And again, to kind of rephrase insurance guarantees, it's certainty of outcome. So you know exactly what you're going to get over what period of time, and you know exactly how it's going to be taxed. And that's not always the case when you actually invest in the underlying investments.
Yeah, this is a point. I think what you just said is control over taxation that I think is underappreciated in the financial planning community. And that is that especially someone who is not quite at retirement yet, it gives them the ability to take an asset that would have been annually taxable. So they have to pay taxes on all the gains every year, something like a bond or a CD, and turn it into something that you can pull the gains out in a lower marginal tax rate environment. Essentially, you can achieve a tax arbitrage play through the use of an annuity chassis. That's very attractive. I just want to very quickly point out that a lot of financial advisors who are not familiar with annuities, when you bring up the idea of firm-specific risk, that's something that they get very scared about. So, they're actually more comfortable with credit risk than they are with that risk of handing over a large amount of money to a single insurance company.
What's interesting about that is it depends on when we're having this conversation. So if we were having this conversation in 2009, I think they would feel a lot more comfortable about insurance companies than probably anybody else, because we didn't really have a lot of insurance company failures, especially not these types of insurance companies after the great financial crisis. We've been in a credit lull for 14 years where we haven't seen a lot of defaults. We also haven't seen a lot of carrier issues. So I think the single issuer thing is kind of interesting. I think that kind of ebbs and flows. I will say this though, one of the great kind of flexibilities and power of the annuity market is that you can choose what kind of risk you want. You can sell an annuity backed by a AAA rated company that has a higher credit rating than the US government. You can also sell an annuity writer that has much lower credit ratings. And generally speaking, you see the same effect that you see in other investments, where the further down the credit spectrum you go, the better yield you get, because those carriers are holding less capital against your policy. The guarantees are backed by less hard capital at a lower rated company, usually, than they are at a higher rated company. So you can kind of make that choice. So if a financial advisor is kind of spooked by the idea of a single credit risk, pick a company that's been around for 200 years with AAA ratings, and you're not going to have to worry about it. Are you going to get the top rate? No. Are you going to get credit quality that's arguably better than the US government? Yes. And so I think you can kind of make that choice in how you want to position the product.
What is probably not that well understood right now is that some of those rates on MYGAs, it's gotten very competitive over the last 2 or 3 years. So the guaranteed rates are pretty high. And the alternative then is that you buy a product where essentially you're investing in the general account portfolio of the insurance company. They guarantee that you'll get your money back. But then there's that slice of cash that you're using to buy call options, that option budget. So explain to us the mechanics of how that works. When does the insurance company buy the financial option? How does the performance of the financial option, how is that used to estimate your interest crediting rate?
Yeah, great question. So that is exactly what's happening. There is an option budget, and the option budget, again, is the fixed interest you could have earned as a policyholder. Now, whether the carrier makes that available to you or not is a separate question. So all carriers have fixed accounts in their FIAs. They don't always set their fixed account rates the same as their option budget, because they may be trying to incentivize behavior, for example, to push people more into the indexed options, or sometimes, like we saw one today, actually, where they're trying to push it out of the index options and into the fixed. So theoretically, the client always has that choice of, I want the fixed or I want the indexed. And the indexed, of course, the option budget is equal to what the fixed rate would have been. So mechanically, here's how it works. They go out, you put your money in, and let's just assume they sweep it every day. You put your money in, you buy the contract gets issued, contract gets funded. The carrier goes out and basically buys an option with what they expect to earn over that year. So they're going to go out and pay 4% for the option on day one. That option exactly replicates the index parameters that they provided to you over the next year. So if they say, for example, you have a 50% par rate, they are buying an option that exactly replicates that 50% par rate. The carrier does not make money on that trade. So one of the things I think people get a little bit torqued around sometimes on these things is they think, oh, well, if I buy a cap, for example, which gives me 100% exposure to the index between the floor and the cap, so let's say it's a 10% cap. If the index goes over 10%, the carrier makes money. And if the index goes less than 0%, they lose money. No, that is not how this works. That would be a terrible business model for insurance companies. They'd have to hold a ton of capital against that. It would never work. So what they do instead is they offload all the risk to the investment bank by buying, in that case, an option that exactly replicates the cap. And that's, if you want to get technical on it, it's called a call spread. They're buying an at-the-money call. They're selling an out-of-the-money call. Those two things offset above the cap, right? And so you only get that sliver of credit between those two, and the carrier is, they're out of the financial equation, right? They are effectively saying, we've hedged this, it's done. Whatever the option pays off should exactly match what we owe the policyholder. And that process repeats. So if you're in a 10-year FIA, every year, they're getting proceeds from the options, and then you're re-upping into an index crediting strategy. They're going out and buying another option. And so every year, they're going to buy this option package that exactly replicates whatever the index parameters they're giving you. Now, where it gets quirky is option pricing changes every second. We're constantly seeing option price. So they're never perfectly matched. There's always a little bit of art and science to this process. There's a science of saying, okay, here's what the option should be. And then there's the art of saying, all right, well, but on this given day, we may not be able to change our index parameters fast enough to reflect what's happening in the market. And so you get little mismatches between the exact value of the option or really the price of the option and the hedge budget. They're always going to hedge it perfectly, pretty much perfectly. But the value of that hedge may be a little bit more, a little bit less than the option on any given day. And it's up to the carrier to set their rates to make sure that they don't lose or make money on this trade over the long run. So that really is it. And again, I don't want to overcomplicate it. Carriers are not in the business of taking equity risk. They're in the business of investing money and earning a spread. All they're doing here is just converting that asset yield into an indexed credit. They're keeping the same spread. They're letting the investment bank manage the equity risk.
The American College of Financial Services, championing causes, connecting communities, delivering best-in-class applied financial knowledge and education
for the benefit of professionals like you and for the benefit of society.
Expand your opportunities at the all-new theamericancollege.edu.
So in terms of the cap amount, what is it that determines? Obviously, it's going to be the interest rate is going to give you more of an option budget, but also the volatility of that index, right? Because options are priced that way.
And this is where things get really quirky. So option pricing, first of all, most people who are on this call are probably not option pricing experts. And so there is a little bit of an education gap, I'd say. You said what I think most people think, which is like, volatility is the primary input into option pricing. And yes, that's true. That is true for par rates. That's true for at the money call options. Any option in isolation, increased volatility will cause a higher option price, excluding any sort of unique variables. And there's some other unique sort of elements on certain options where that's not true, but just vanilla call options, that's absolutely true. Higher volatility, higher price of the option. However, there's other factors too. So one factor that also matters is interest rates. And so as interest rates go up, the price of the option goes up too. And so one of the things I think that caught people a little bit by surprise in 2022 is the fact that you already mentioned it. MYGA rates went up faster to some degree than we saw caps go up. And the reason why is because cap prices also went up as interest rates went up. So we had volatility kind of cooling off a little bit, but interest rates are going up, and that was pushing up the price of the option. But caps are a perfect example because there's actually a third factor in caps. So I mentioned a minute ago, the way you hedge a cap is not with one call option, it's with two call options. We buy the at the money, we sell the out of the money. So you actually have a third factor here called volatility skew. And this is where people's heads like explode because people think of volatility as being the VIX. Okay, the VIX is a very particular diagnostic. It's like seeing one frame of a movie, okay, and then making a judgment about what's going on in the whole movie. The whole movie is what's called the volatility surface. And by selling two options, or by buying an option and selling an option, you're actually at two different points in the volatility surface. And volatility isn't priced the same across the different strike prices or the different durations. And so what you have is a situation where the volatility between the floor and the cap may be different, those two options. And so you have this thing called volatility skew. And if you actually look at some of the biggest drivers of pricing for caps, it's not market volatility. That's actually not a big deal. It's interest rates and it's volatility skew. And by the way, no one really knows why volatility skew exists. There's no god of volatility skew that deems every day this is how the implied volatility slope is going to work. It just kind of is the market phenomenon, it's a supply and demand phenomenon. And so we see really wonky things happening sometimes in the options market related to those three factors that directly impact what carriers can offer. And so you might see situations, for example, where par rates really drop, but caps don't. Okay, well, what's going on? What's going on is market volatility went up. Par rates are only one option. Caps are two options. Volatility is going to hurt the par rate, but it may not even hurt the cap rate. In fact, caps might actually get cheaper in certain high vol environments, depending on what happens to skew. And so that's where, again, I think people get really torqued up around FIAs because you don't ultimately know what's driving some of these rate decisions at the carriers. You know, if you have been paying attention, you know it's option related, but they're not going to be transparent about that. And so I think one of the things actually carriers really should do is just be much more transparent about this. And I even think carriers should go so far as to say, you know what, we're going to actually tell clients, here's the price of the options. Here's why we did what we did. Here's our rate setting. We're not going to set rates every 3 months whenever we feel like it. We're actually going to set rates every day because that's the way the option market is going. So I think there's an argument to be made for more transparency here because to your point, without that, you really don't know why things are happening. But there is a clear reason behind the scenes. It's just not always obvious.
Well, let's talk about a very important transparency point, which is the selection of the index. Talk to me about, and there are problems going on right now. I think there's a lot of criticisms about illustrations, cherry picking indexes, looking in the rear view mirror to select an index that's going to make something illustrate better. Tell us what's going on there.
So it all goes back to option pricing. So again, there's kind of two main factors in option pricing for a single option: interest rates and volatility. And a third one actually is dividends. Dividends are a smaller component, but it's still in there. So what we've seen really since 2015 or so is an explosion of indexes that are what I call engineered indexes. These are indexes designed specifically for insurance applications. And so the design of these indexes are basically to ensure that the option prices are stable. And so these are volatility controlled indexes. And so the index itself manages volatility. Okay, how does that happen? Well, again, it's not complex. Imagine you have a very volatile asset and a non-volatile asset. So imagine we have, for example, equities and cash. If I want to maintain a constant volatility, then I know that cash is always zero. I know that equities are moving around like crazy. If I combine these into one index, I can change the allocation of cash and equities every day to keep the overall portfolio volatility level the same. And that's the way all these indexes work. And so they all are kind of constantly blending cash or other low vol assets against high vol assets to create target volatility. And then they're also what's called excess return. So they actually subtract the interest rate, the risk-free rate, from the return of the index, which removes the interest rate component of the option. So the benefit is you get very high participation rates, you get great optics, and along the way, you also get another benefit, which is because you created this index today, you know exactly what history you're going to be pulling for your back test. And so you can optimize your asset strategy, you can optimize your algorithm, you can optimize your asset holdings to make sure that it illustrates really well. And so, yeah, we're seeing some crazy stuff in illustrations right now where there are FIAs out there illustrating 30+% annualized returns. And that is a pure and simple fabrication that is of historical data. It's a manufactured return. It's not a realistic going forward return. It's the kind of return you'd get if you were in school and your teacher handed you a test and you already memorized all the answers to it because someone had already given you the answer sheet. Like, that's kind of how that works. And so that's the difference between that and, let's say, the S&P 500. S&P 500, you don't know the answers. The test is always changing, right? These engineered indexes, you already know all the answers. And so you just fill them in. And so we've seen, carriers sort of exert early on, carriers say, we're going to exert some rigor on ourselves to not take advantage of that. And all that's been kind of thrown out the wayside. And so what I'd say to advisors is just, look, again, don't get hung up in that. At the end of the day, what's an FIA? An FIA is a fixed deferred annuity where instead of getting the interest, you go out and you buy options. Unless you think you're buying options that are going to produce profits of 500-600% every year forever, then you should just assume that an FIA is going to perform very similarly to a fixed deferred, except when equities happen to be doing very well, like they did for the last decade, you're going to do better than an FIA. Or if equities happen to be doing very poorly, you may do worse than if you actually taken the fixed rate. But the assumption that you're going to earn 30% returns forever is complete and total lunacy. And unfortunately, that's what we're seeing in these products.
So what should an informed advisor do if they're, and this is a point, I want to make 2 points here. First of all, how do you pick one? What kind of an index makes the most sense? And my second point is, why a product that correlates so highly with the remainder of your portfolio as part of your bond allocation when you could just simply invest in something that provided you with a guaranteed return over a fixed rate of time? From a portfolio perspective, this type of a product, which has a rate of return on average that's pretty close to a bond portfolio, right, maybe you're going to get a little bit of an equity risk premium, maybe not. And then it correlates with the remainder of your equity portfolio. What's the benefit there?
Yeah. Great question. I think the benefit is people aren't thinking about it always in the overall portfolio. They're thinking about it a little bit more in isolation. And they're saying downside protection, upside potential. And so you get a little bit of equity flavor in a fixed product. That's the traditional kind of way it's been positioned. I think to your first question, which is how do you pick these different indexes? I think what these different indexes are trying to do is say, whoa, Michael, you've got this kind of categorized incorrectly. If we can make it look more equity-ish, then instead, so the traditional allocation for fixed products has always been, instead of fixed income, do annuities. And I think that's a great argument, by the way, or at least as a complement or as a piece of your fixed income portfolio, do annuities. And I think that makes total sense. What a lot of these illustrations and therefore the sales practices are trying to do is also use FIAs as a replacement for the equity sleeve. And so to your point, they're not thinking about it as a non-correlation asset. They're trying to say, hey, instead of buying stocks, why not buy this FIA that illustrates at 30% with no downside risk? And by the way, I don't know about you, man, but if I legitimately thought I could earn 30% with no downside risk, I would put every single dollar of my net,
every single penny. And so would every private equity firm.
Exactly. And instead, they're actually the ones selling me options. Okay. So they're the ones on the other side of the trade. So that's a bit of the irony here is like, who's the sucker around the table? If you can't spot one, it probably is you. And I think when you think about that for an FIA, kind of like who's the sucker around the table? Well, only the policyholders are the one actually taking the risk. And so if you appropriately set expectations and the policyholder thinks of this as a fixed income alternative, it's going to do exactly what you want it to do. But if you think of it as an equity alternative without taking any equity risk, that's where we get into a lot of trouble. And I think that's been the migration of FIAs over the last 10 years is less about a fixed income alternative and more about an equity alternative, whether the advisor explicitly says that or not. When you drop down an illustration that shows 12, 13% returns, 20%, 30% returns, that's where the client's mind goes. Like historically, fixed deferred annuities, MYGAs, FIAs have always been a fear sale. And now that illustrations have gone crazy, they've kind of turned into a greed sale. And so we've seen that dichotomy there. Now, we have products that are good for greed sales. I'm not saying greed sales are bad because clients want to take risks. They want to get compensated for it. We have variable annuities where you can go and invest in mutual funds inside of an annuity wrapper, get the exact same tax deferred benefits without the insurance guarantees. And you should expect a VA to outperform an FIA or a fixed deferred. Nobody runs around telling clients they're going to earn 30% in their VAs. No fund manager who lets funds into a VA is going to show a 30% compound return over 10 years. That would literally be illegal. And yet we allow that to happen in FIAs. We also have, another product category that's really grown a lot that is a viable equity alternative and is allowed to be marketed as an equity alternative because it is a registered product, and that's RILA. And what is a RILA? Don't get hung up on the acronym, right? RILA is an FIA with downside risk. So you have a defined level of downside risk and you have a defined level of upside potential. Whereas on a FIA, 0% floor, RILA, you can have a negative floor. You can have a buffer. You can have participation on the downside. And the idea is, thinking about the spectrum of kind of risk, you have MYGAs all the way over here. You have VAs all the way over here. FIAs are somewhere right around here. And RILA is kind of somewhere right around here, just below a VA theoretically. And by the way, this is all getting grayed because you have RILAs that kind of have VA funds too. What is that? Okay, well, that's a multi-use product. But if you just kind of categorize them that way and say, okay, we're getting index credits with some level of downside risk. Okay, well, that can be an equity alternative in a way that an FIA isn't. I guess I'll put it in simple terms. You have to take risk to get more return. So it doesn't make any sense to market an FIA as a zero risk equity-like return. When you have RILAs where you actually take some equity risk, you would expect that product to outperform a product where you don't take any equity risk. That's kind of the way the whole thing works. And yet the marketing's messed it up and has kind of inverted some of this because these indexes have such massive illustrated performance.
Oh, Bobby, that is such a perfect lead in to a discussion about RILAs because they have become so popular recently and people love this idea of something that provides, say, a 10% or a 20% downside buffer. It fits perfectly well with the behavioral finance concept of loss aversion. So, it's essentially an option created product that allows you to not have to worry about the first 10% of losses. But there's an aspect of RILAs that I don't think is well understood. And I know that you're going to have some fun talking about that. And that is that the sale of out of the money put options has historically provided a bonus. And any sort of a product where you have to sell put options as part of the design of the product, and they're relatively inexpensive, you can actually get RILA strategies that start looking incredibly compelling, especially when you blend it with the tax deferral benefit.
Yes. So the way we think about this from a product manufacturing point of view is what products eat vol skew and what products eat that phenomenon, because that phenomenon's been really strong recently. So to your point, when you're selling that out of the money put option, and that put option is very valuable, right? What products benefit from that structure? And RILA is a perfect example. So in a normal market environment with normal skew, floor options should be better than buffer options, but we are not in a normal environment. Skew has gone absolutely ballistic. And actually recently it started to cool off, but up until a few months ago, it was going ballistic. And to your point, RILA basically feeds on that. And so that makes the caps on those super high. A lot of them now are uncapped. A lot of them have 100% plus par rates. And so you can say to a client, hey, you're investing in the S&P 500, you get a 10% buffer, and you get 110% par rate or 120% par rate over a 6-year period. Who's not going to want that? Now, to your point, that's an option pricing phenomenon that is manifesting itself in the rates. It's also the fact that, look, we're not paying, you're not getting any dividends on that S&P 500 index. And I think that's one thing that people really kind of forget is, okay, so imagine you have a RILA with a 6-year term, 10% buffer, 100% par on the upside. The natural conclusion is, oh my gosh, this is great. I'm going to own the S&P 500 and I'm going to get 10% protection and 100% of the upside. Why would I not want to do this deal? Well, here's the reason why. Because over 6 years, with S&P 500 dividends around 1.75 a year, 1.6, you're going to get 10% back in dividends anyway. And so whether you buy the S&P and hold the dividends in cash, or whether you have the buffer at the end of the term, your result is actually going to be very, very similar. And so that's not an arbitrage condition. However, to your point, when vol skew is going crazy, it does feel like an arbitrage condition because RILAs look so good because you're selling that out of the money put. So here's my argument back on this. And by the way, I'm a RILA fan. I love the definedness of a RILA. I think to your point, the behavioral psychology is really important. I think the hold period requirement is really important to have clients thinking long-term and not making instantaneous decisions. I think there are great planning applications for RILAs above and beyond their return characteristics. But think about it. If the market is pricing in that put option is super valuable, basically what the market is pricing in is a higher likelihood of a negative 50% drop. And so one of the ironies about RILA is people say, oh, the market really doesn't go below 10% very often. And yet they're going to sell this product where the put option is super expensive that you're shorting. Well, the market's telling you that the chances of a steep drop are really high. That's why the put option is so valuable. And so it's a little bit of this kind of like psychology of like, I'm selling the put that the market thinks is valuable, but I don't think that drawdown is actually going to happen. We'll see. We'll see what happens over 6 years. What I think about RILA is it's more about the conversation. It's more about tax deferral. It's more about planning. It's more about behavioral psychology. It's not about the attractiveness of the rates, because that's going to come and go. And you may be making a bet on that I think, again, clients don't really have a good kind of internal barometer for, and advisors don't either. They may not realize they're taking a pretty concentrated bet on a couple of things happening. And if those happen, you're going to get big losses in those products. Don't tell your client that a 10% buffer is going to protect them in every scenario. It's not. The fact that you're selling a valuable put option tells you that the market actually thinks this is really valuable protection that you're giving them, and the client's going to pay for it. And so that's the dynamic with RILA.
The argument against that, Bobby, is that historically the market has overpriced those out of the money put.
Yes.
And so you're essentially, if that is a behavioral phenomenon, you're actually benefiting from that behavioral phenomenon the same way that you would benefit from, say, a low vol premium that you would get with an equity portfolio. Is that a mispricing that you can actually take advantage of?
Totally agree. And maybe you make that argument, but that would not be the first argument I would go to in favor of a RILA.
I agree.
That would be one of the last arguments I'd go to. Because you know what? I know for me, I would say that to a client, and then lo and behold, it'd be my client that ends up buying that policy in March of 2020, for example, when the credit comes due and they get hit with a 40% drop. Just my luck, So I would be careful on. I agree. I think there's an argument to be made of what you're saying, but again, that's further down the list to me of why these products are great.
Well, and you get the added element that part of what you're paying for can actually be reimbursed by the tax deferral benefit of the product. So you have a bunch of non-qualified assets. Of course, the argument is that equities are very tax favored anyway. So why put an equity like investment within an annuity wrapper and basically turn capital gains into ordinary income? So there's a lot of trade-offs there. Bond like strategies, generally speaking, fit better within some sort of an annuity shell. But that element of the RILA is very attractive. Now, what are some of the benefits of holding that type of a strategy within the annuity wrapper as opposed to holding it within, say, an ETF?
Yeah, so you could do it. I like ETF structures for this, by the way. Tax incidents, I think, is some of it. So there is a little bit of an open question on how structured notes are taxed, for example, and how some ETFs like that are taxed. Options are usually ordinary income, but some people have argued structured notes that are built like this should be cap gains. So there's some uncertainty there, whereas there's total certainty around the annuity. And then I think it just goes back to tax control. Your point is correct. If you're going to get capital gains and instead you get ordinary income on an annuity, that does not work on a 2-year time horizon, but it probably does work on a 6, 12, 18-year time horizon, where you're falling into a lower tax bracket as you prolong and get older. And so I think, the variable annuity versus holding the funds outright discussion on the tax side is more of an individual discussion than a blanket discussion. There's a crossover point. It's kind of to advisors to figure out, is this sort of a long-term equity holding where we can actually get to that crossover point, or is this a short-term equity holding where, to your point, you'd rather just pay ordinary income, not short-term capital gains, but like in the 2 to 5 year time frame where it's kind of on the bubble. And so that's why, I think one of the challenges we have in the annuity space is just tax deferral. The way that an annuity product does it is not always necessarily a benefit. To your point, it's what was the alternative, right, and what's the time horizon. Whereas I would contrast that with life insurance, where it is always a benefit to have life insurance because you can get it tax free. And so there's almost always an argument that really any extended hold period on a life insurance contract, your tax benefits will exceed the cost of the coverage. I think life insurance tax benefits are a clear argument and not really an individualized argument. It's a generalized statement. I think annuities are much more of an individualized planning application about whether or not tax deferral actually counts for something that you want. I'd say one of the best arguments I'd make for annuities is more just outsourcing some of these decisions to professionals. With a MYGA, you're outsourcing your fixed income decision to an insurance company and getting a guarantee. You got to pay them for their capital, but you're getting a guarantee, and that's something you can't get in a lot of other situations. And so it's more giving you a financial tool that's a complement to what you're doing, not necessarily, a competitor. It can complement your other strategies, and from a tax standpoint too.
Yeah, I absolutely agree. And I think one of the points that you have to make is that, especially with a bond investment, if it's going to be managed anyway professionally, if a consumer is paying to have that bond portfolio managed, you've got to then subtract also the management fee from the performance of the bond portfolio. Net of taxes, net of fees, you're not getting much from the bond portion of your non-qualified portfolio. It really does make annuities attractive.
But the counter argument to that is, yes, but I have to pay commissions in annuities. And what I'd say is, well, yeah, and actually most commissions in annuities are similar to AUM fees in a managed account. So people are, commissions and annuities are crazy. Like, I don't know. I mean, 6% street compensation on a 10-year FIA product is 60 basis points a year. And yeah, there's overrides. So maybe it's 10%. Well, that's the same as you would have charged an AUM over 10 years. So I don't know. It's not as big of a difference as some people try to make it out to be. I think the commission, I think the heaped commission nature of it is what people are reacting to, rather than the total commission amount. But over a 10-year hold, it kind of doesn't. That actually doesn't matter. As long as you're in it for 10 years, whether it's paid up front or paid over time, it's going to end up in the same result.
Yeah, I remember Bill Sharp has a book on retirement income planning, and he actually backed out the present value of AUM for a retirement portfolio, and it's somewhere between 10 and 12% of your retirement savings. So it's important to be able to make those direct comparisons for different types of options. Bobby, I think we're out of time. We have so many other topics that I'd love to talk to you about, but thanks again for spending your time with us today and sharing your knowledge and experience. This has been a terrific conversation. I've learned a lot.
Thanks for having me. This has been a lot of fun. Hopefully we'll do it again.
That's all for now, but you can find all our episodes on YouTube, Apple Podcasts, Spotify, and most other streaming services. Be sure to like us, follow us, and leave us a rating and review. Shares is a production of the American College of Financial Services, and we hope you join us next time as we share ideas that expand your opportunities.